Drawing from Greek mythology, Daedalus warned his son Icarus neither to fly too close to the sun, symbolizing hubris and overreach, nor too close to the sea, which represented fear and paralysis. Applied to investing, the Daedalus Way advocates balance over extremes. It cautions against narrative-driven euphoria and macro-induced pessimism alike. Capital is impaired by excess risk in bullish phases and eroded by undue caution during bearish phases. We believe current market environment also has segments at both the extremes, and hence our approach to navigate through this market will be the Daedalus Way. After 2 strong years, 2025 was a year of consolidation in the Indian equity markets, with returns diverging across market capitalizations. Large caps delivered relatively modest returns, mid caps experienced bouts of volatility, and small caps underwent a correction. Year turned out the way as expected by us in our yearly outlook, Opportunity in Uncertainty, released in January 2025. Equities went through corrective phase till Liberation Day in April 2025, and since then we saw recovery or rally of 15 to 20% across indices. Markets are at an interesting point with investors at tenterhooks due to ongoing uncertainties, but VIX, the measure of perceived risk, is at multi-year lows. In fact, Indian VIX had come into single-digit just 2 weeks back, which was a record low. The current environment reflects a phase of normalization after an extended period of optimism, alongside rising geopolitical risk. Post-October, US small caps and non-AI related large caps have started outperforming. This price action suggests that momentum in AI is slowing down as focus is gradually shifting from hype to execution and monetization. US military intervention in Venezuela has reignited the geopolitical tensions at the time when the world was beginning to stabilize after the recent tariff-related disruptions. This event may further cement deglobalization and speed up the rise of multipolar world. Global supply chain of commodities will be realigned as US may explore Venezuelan reserve of crude and precious metals. Initiation of similar actions by US on other countries like Iran may lead to significant geopolitical risk, and hence development on this should be keenly watched. Meanwhile, emerging markets are showing relative strength, led by China and South Korea. Further, despite the strong outperformance this year by emerging markets, MSCI EM to S&P 500 ratio is still 1 standard deviation below the long-term average, implying decent scope of catch-up by emerging markets. Indian markets lagged its emerging market peers in calendar year 2025 as MSCI India underperformed MSCI EM by 31% in dollar terms. With global markets having rallied sharply while India lagged, India's relative valuation positioning has improved. MSCI India premium compared to MSCI EM has come down to 47% from 10-year average of 78%. Looking ahead in 2026, several of the concerns like elevated valuation amid tepid earnings growth, the absence of a direct AI-led investment theme in India while global markets chased the AI narrative, and INR depreciation which contributed to the underperformance of Indian markets are beginning to normalize. Earnings are also showing early signs of recovery, with the upgrade to downgrade ratio improving to 0.9, the highest in the last 6 months. The INR, after breaching 91, now seems to have found its footing. RER is also hinting towards a prolonged period of undervaluation for INR. Further, GDP is likely to see pickup as fiscal, monetary, and regulatory reforms start to impact the broader economy, feeding into future growth and earnings. That said, domestic equity supply is expected to remain an overhang through 2026. The temperature gauge index remains in the fair value zone. Our outlook is cautiously constructive and firmly anchored in execution rather than narrative. Large caps enter 2026 on a stronger footing with reasonable valuation and earning visibility. Mid and small cap are in the downward momentum, which may create selective accumulation opportunities during the first quarter of the year. From a portfolio perspective, a balanced approach is recommended, anchored by large caps or hybrid funds, complemented by staggered participation in selective mid and small caps. We would prefer index-led or hybrid strategies in large cap while active focus strategies in mid and small cap. While valuations have corrected from peak levels and earnings momentum is improving selectively, we expect 2026 to be a year of consolidation and bottom-up stock selection rather than a sharp, index-led rebound in mid and small caps. Equity view, neutral, portfolio allocation, 50% allocation to large caps or hybrid, 10% to global and 40% allocation to mid and small caps. Investment strategy, lump sum investments in hybrid funds at current levels. For pure equity-oriented strategies, a staggered SIP or STP approach over the next 3 months is prudent given elevated valuations and higher volatility. Any sharp correction should be used for aggressive deployment. From a fixed income perspective, we believe that most of the uncertainties are behind us or have been factored into the price. RBI's approach might be more data-dependent as the stance remains neutral. With inflation continuing to remain soft and next year projections are also being revised downward, it may provide some further room for RBI to cut the rates during calendar year 2026, especially in the backdrop of likely softening by US Federation. While rate action is one measure, RBI has been using OMO purchase and US dollar to Indian rupee swap to infuse liquidity in the system, and CRR cut has also come into effect now. Moreover, it seems the tendency to borrow more at the long end of the curve by government will also likely be controlled going forward, as weighted average maturity of outstanding sovereign debt has already increased to above 13 years now. Given this backdrop and higher term premium of approximately 140 bps, 10-year repo rate, compared to 10-year average of 100 bps, we believe that steepness of the yield curve may come down in 2026, and that should be led by softening in long-term rates. Hence 10-year per 15-year G-Secs look attractive from a tactical perspective. Note that we continue to favor accrual strategies across the credit spectrum through both direct and managed route, along with income-generating real assets like infrastructure investment trusts for core allocation. Infrastructure investment trusts may see some capital appreciation as well due to softening in rates. For shorter holding period, 6 to 18 months, one can also allocate in relatively liquid fixed income alternative solutions like arbitrage funds and hybrid SIF funds. Precious metals had a very strong year, with MCX Gold Spot up approximately 79% and MCX Silver Spot rising approximately 172%, outperforming most of other asset classes. Gold's rally has been more structural and policy-driven. Its rise has been supported by sustained geopolitical uncertainty, President Trump's tariff policies, central bank purchases, loose monetary policy and overall unrest in the market. Over the last 3 years, 2022 to 24, gold has risen against the fundamentally non-supportive backdrop, rise in US yield and dollar index, booming equity market, solely on the back of CB buying. Some of these fundamentals also become supportive as yields have fallen and DXY has corrected by approximately 10% from peak. Gold continues to be viewed not merely as a defensive hedge, but as a strategic portfolio asset amid ongoing fiscal imbalances, currency debasement, and an uncertain monetary policy outlook. While returns may moderate, there is a reasonable likelihood of low double-digit gains aided by modest INR depreciation over the medium term, with accumulation best done on dips. Unlike past speculative spikes in silver, this move is fundamentally driven by a multi-year structural supply deficit and irreversible industrial demand from solar, EVs, and technology. This is further supported by financial demand, as expectations of rate cuts, lower real interest rates and strong ETF inflows attracted investors. Overall, silver is undergoing a structural repricing, establishing a higher long-term base rather than a cyclical peak. However, silver is highly volatile, and one should not expect a similar rally in 2026. But, considering the use cases of the same, some exposure in the portfolio is beneficial. Investors with high exposure may consider partial profit booking, while those with low or no exposure can accumulate in a staggered manner, capitalizing on market dips.